All right, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem. Today, we got Jack Stone, Managing Director at Greysteel in the Texas market, and also co-host of the CRE Daily and the No Cap Pod. Jack, it's good to have you on, man.
David, I'm a huge fan. Thanks for
Likewise.
thanks for the invite. This is great.
It was fun. It was fun running into you at Best Ever Conference, and it was actually funny because I didn't realize you were a co-host of the No Cap Pod until maybe like an hour into our conversation. I'm like, dude, I listen to that pod all the time.
Oh, it's so funny. Yeah, it's you probably run into this as well, but it's people listen to it, right? So it happens a
Exactly.
lot with me too. It's like, oh, that's you. So I
And
get it.
we're both on video. Like we both have video form, but not everyone
Sure,
looks at the video when they're listening to the pod. And
correct.
then you meet someone and then maybe they recognize your voice or you get deeper in the conversation. You're
Yeah,
like, holy shit, I listen to you every week. I listen to you every other
yeah.
week.
Yeah, which is the most flattering compliment you can get, right?
Yeah.
Super cool to hear that.
Yeah, and then I mean, maybe I'm just the idiot, but I didn't really realize that CRE Daily and No Cap were connected, and I was like, subscribe to
Yes.
CRE Daily, and then I was listening to No Cap, and I'm like, oh, this is the same entity, which you're
So
co-host and co.
my question for you is, did you start with no cap or did you start with CRE Daily?
I started with CRE Daily, but
Okay.
I probably like perused it a bit. You get like the
Hmm.
spam of emails and you're busy and you're not always have the time to check CRE Daily. But then no cap, I have a designated podcast listening time when I'm in
Yeah.
the morning working out or running or in the car. So
So I don't know
I
how
I
people do that. I hear a lot of people who listen to their podcasts when they work out, and like the last thing that will motivate me when I'm working out is listening to people talk about real estate. But
You're telling
I'm
me talking
jealous.
about value add multifamily is not gonna get you
Yeah,
pumped?
yeah, I'm good. But yeah, I think if you can multitask that way, what a great way to kill two birds with one stone.
I think the idea of just being super productive, that you're also working out while like, getting this
Totally.
wealth of knowledge is
Yeah.
that's my take on it of why I listen to pods while working out. But I
Yeah.
definitely agree. Your workout's probably not as intense if you're listening to just us spewing out market data than listening to some really sick playlist
Whatever.
that's just
Some
gonna get
beat.
you high. Yeah.
Some beat.
Yeah.
I like a beat. Yeah.
You
Yeah.
need a beat. Yeah. Yeah. Well, Jack, good to have you on. I mean, something a little bit different that we do here is we want to get into the weeds. We want to talk about what you're seeing in the market, and you cover the Texas market. You live in Fort Worth, right?
Dallas.
In Dallas? Okay. Talk to us a little bit about, first of all, why Texas? I'm sure you get that a lot as a broker and pitching your
Sure.
product, and the time in the market we're in right now, and why you think it's a good time to invest in
Oh
in
man,
the Texas market in general.
we could talk all day on this topic, right? But I'll give you some quick background on myself, and then I'll talk to you about kind of the market and what we're seeing out there. But I help run our DFW-based multifamily sales team. We have 10 full-time multifamily investment sales advisors that cover really most of DFW and most of the state, except for Central Texas, which is covered by our office in Austin. We have a little over 15 offices across the country, and Greysteel's headquarters is based out of Washington, D.C. So outside of Washington, D.C., which we have a pretty big presence in just throughout that whole mid-Atlantic region, I would say Dallas is our second largest office. Our niche and bread and butter has traditionally been that middle market space, mostly private capital, although at any given day, we probably have one or two more institutional or semi-institutional deals we're working on. And we have a capital markets team as well in-house that will place not just debt, but also equity that's been growing nicely as well. So hopefully that gives you a little bit more background on us. And I come from a legal background. I grew up in Dallas, went to University of Texas for college, went back to the University of Texas for law school. I practiced for 4 grueling years at a big law firm, national firm in their Dallas office. Wasn't for me. I didn't like it. I remember one day working on a case for a real estate client of ours, and he was a broker doing phenomenally well. He was also putting deals together on the side. And I saw how much money he was making, and I saw his quality of life. And he would come in a t-shirt and jeans, and I'd be wearing a suit working till, 10 p.m. every night. And I'm saying, wow, this guy does better than the partners I work for does. And he doesn't hate his life. And so that was kind of the beginning for me to somehow get out of law and get into real estate. I loved the multifamily fundamentals back then. I still do. Everyone I knew that was in real estate at that point was telling me you got to get into multi. And this was during sort of the Amazon effect, craziness with retail where no one
Right.
wanted to touch retail. Of course, that's changed a lot recently and shows you the resilience of retail. But everyone was saying multifamily, multifamily, multifamily. And so now it's been 8 years, and here we are. Yeah.
Do you have any regrets with
Uh, uh,
not sticking into law and coming
yeah. I
into
mean, listen, it's funny. I some people, we just had on the president of Harvard Group on our podcast. And, I didn't realize he also was a former attorney, and that's how he came over to Harvard Group. And he had a very politically correct response when it came to that type of question. I'll be honest, I definitely regret it. I think I
Yeah,
think that I think for the time and money you spend, right, on and a degree where you could be using that time elsewhere and saving that money, it just becomes a cost benefit analysis and kind of,
right.
what's worth it. I graduated law school in 2012, meaning I went to law school from 2009 to 2012. What was probably the best period of time in our lifetimes to get into real estate?
Right, that
Right after
window,
2000, yeah,
exactly.
that's it. And
Exactly.
so it would have been nice not to have to deal with, student loans and go right into the business. But people like Richard would say, hey, it's going to benefit you in the long term. You're going to think more critically, and you're going to be better at whatever it is you do. The interesting thing about brokerage and investment sales, and you know this because you talk to brokers all the time in your business, is I think it's the ultimate equalizer. I think you can be a broker, and whether that's leasing or investment sales or capital markets, and you don't even really need a high school education. It doesn't matter. What
It's
matters
so
is
true.
it's the hustle and it's the relationships that you create during during your path. And so I think one thing for me that I had to realize very early on is, don't let ego get involved at all. And it's a constant fight, by the way, especially in this business, because there are so many egos and there's so many down points followed by a high point, followed by a million more down points. But just because you have some fancy degree doesn't mean you're better than anyone.
No, the most successful brokers don't even know real estate. And so it goes it goes back to hard
That's
work.
funny.
It's really
Yeah.
like it goes down to hard work and grit, which and thinking it still requires thinking out of the box, which I think
Yep.
you do a good job of as well, and broadening and networking, as you said, comes down to the relationships.
It's huge, and you got to stay in front of people. People aren't just going to always think of you. You have to stay in front of them. Hence why, I think people look at other avenues of keeping their names out there, just like speaking of podcasts, right? Whatever you can do to just stay in front of folks, because we're in the attention getting age, and everyone has only so much bandwidth, you know?
Yeah. Yeah, exactly. Just staying top of mind is kind of
Right. Right.
so
So they say.
yeah, exactly. Um Jack, so I guess I want to go back into the market. We actually own a deal in Dallas. It took us years to break into the market. It's such a different market than some of the other states we own in, where you have a ton of inventory already there.
Hmm.
You have a huge amount of 80s vintage and 90s vintage. I think the construction boom in Dallas was 80s. I think the most amount of inventory
Yep,
of per vintage of every decade was 1980s.
it
And
was.
as a class B C owner, that's like our bread and butter. Typical value add, take some 80s, renovate, get the NOI up, maximize value, and flip in 3 to 5 years. What we
Right.
found is there's also so many players that are chasing that type of product, and big and small. And so I kind of want to talk to you from based on what you're seeing in the market. We could start with Dallas and then go into broader Texas, about the Class B and C space with all the supply that came in, and the dynamic that I was just describing. Do you think it is a good time to buy Class B and C, and why? Make your case.
Sure. Yeah. Well, great setup. We're at a really weird time because, and this is no, I don't want to, repeat ourselves too much. I think most of your listeners kind of understand the dynamics, but in case they don't, there has been a tremendous amount of supply coming online throughout really all the core Texas markets. COVID just really accelerated growth and money was cheap. We had a lot of in-migration, in Texas, a lot of people moving from California and elsewhere, and it was a good time to build, so we thought. The problem was everybody wanted to build. So we hit this sort of inflection point where there's too much supply coming online to support demand, and therefore you got a bunch of new multifamily properties all throughout the state, particularly in Dallas. Austin's the worst, where you can't get anyone to sign a lease without offering them 2 to 3 months concessions and dropping your rents. And tenants are smart; they'll play sort of the game. They go 1 year here, get a concession. They go another year here, get another concession. And so right now in the class A space, there can be some deals because there's so many properties that are struggling and you see buyers who want to be in that DFW market in particular, and they see this sort of below replacement cost narrative, meaning they can buy a class A deal at below the cost it would cost to build and ideally hold on to it for another 2 to 3 years as it barely, creates enough cash flow to cover its carrying costs and debt to then be cash flow positive. And so they're all sort of hoping on this knight in shining armor of uh, rents starting to stabilize, occupancy stabilizing, and more in migration, and just absorption, right? And I think it's not. I think we will get there. The question is, how fast will we get there? And so, depending on your capital, right? If you have patient capital that believes in the narrative that in DFW you're going to hit 4 or 5% rent growth in 2 or 3 years, then be, you might be looked at as a genius. But it's certainly a risk, and we don't all exactly know where we're going to be in 2 to 3 years. And in-migration has slowed a little bit in Texas, but it's still one of the fastest growing markets in the country. Still amazing fundamentals. I think it's a great place to be long term, and I think you'll always have some liquidity. In other words, you'll always be able to find buyers that will want to be in markets like DFW. Um, so that's the Class A product. Everybody's chasing it. the Class B and the Class C product, you asked in in your actual
Right.
question, which I digressed on for 30 minutes. Um, that is a different story, and it's a different story because much fewer people want to touch it.
Mhm.
And you've probably seen this as well, but we've seen this sort of flight to quality. Everyone seems to start out in the 1970s, 80s, Class B, Class C space. And ultimately, as they have some success, they move on up to the Class A space, whether they get some more, you know, cheaper cost of capital, partnering with institutions, kind of prove your worth and so forth. Um, but because it's much harder to find buyers for that Class B and Class C product, um, I think there's some really good opportunities. And there's reasons why there aren't as many buyers for that, right? It's the sheer amount of new supply that's come online, creating opportunities to buy these new deals, like I had already covered. It's also just the cost of operations. These Class
Mhm.
B and Class C properties, as you know, have gotten increasingly expensive to operate. Things break down. You're running something that has to just nonstop be worked on over and over again. And so it can create this problem where, you might not actually be cash flowing because you're putting back all your money into just keeping the deal afloat. And so right now what we're seeing a lot of these syndicators who bought these Class B and Class C properties in 2022, 2023 at the height of the market. They overpaid, they overlevered. Because they overpaid and overlevered, they had to use floating rate debt. Not a great time to have any sort of floaters out there, as everyone knows. And they're in trouble. And because they're in trouble, there's some blood in the water. And so I think there's some really attractive buys and resets where, a group bought a deal in 2022 for 125 a door. You can probably find that same deal for 80 a door in certain markets, right? Um, just a total reset, sometimes even already stabilized, so you can put agency debt on it. Um, Sometimes the lender takes it over once you assume the debt. Oftentimes, I'm getting into too many sort of nuances here, but oftentimes I think it's still too much debt. I mean, we're
Mhm.
seeing deals out there where um, it's REO, and the the pitch is, hey, you can buy this with very little down. 5% down.
Yes.
This is yours, right?
Yes.
But it's still more often than not won't pencil because there's still too much debt, which just goes to show you how inflated these prices were to begin with, right?
Yep.
If even after all that equity is wiped and you have a clean capital stack of just debt that's left over, it still doesn't pencil without the lender taking a loss of some sort.
The way I see it, to your last point, is the too much debt. You need to have runway to grow out of it, and you have to believe in that growth, to at least give you a shot. And one of the things I'm starting to see in some of our markets, and I've seen it a few times in Dallas, is lenders starting to work with borrowers in a way that borrowers now have a little bit of leverage, saying, "Hey, you want me to buy this with little down, you're my partner now. And as a partner, we need to come up with a cap stack that works for both of us so that our
Yep.
interests are aligned." So that could mean more runway. It could mean accrued interest, where it's like, hey, this 100 LTV, yeah, we'll put $1 million in interest reserves. But if that $1 million gets run out and we don't hit our business plan, I'm not trying to be in the same position as the previous owner.
Yeah.
And so let's
Right.
work together. Let's accrue the interest. Let's give the property a little more runway. I can't be in this for 2 years and expect to flip out. I don't want to be in the same position as your previous borrower. So I am seeing a little bit more of that today than I've seen in the past, 3+ years when rates started to hike. I don't know. What's your take? Have you been seeing lenders kind of working with borrowers in that regard?
Yeah, of course. I mean, lenders don't typically want to be managing properties. And
Right.
so yeah, I'm seeing a lot of that. I mean, there's a lot of deals where we've been BOVing for the last 3 years. where they've they've been in default for the entire 3 years, and
Right.
the lenders don't want to take it back. So we're in this sort of weird space, and what I think we're all hopeful on is that we see a little bit of a little bit of pressure taken off of us with rates. And as you and I are speaking today, it doesn't really look like that. But um, you know, it there's so many things going on out there. But we're kind of in this weird, funky place where things have kind of stopped or slowed, but then they can pick back up very quick. And I've seen this happen before where like one month just slowed down tremendously, and then the next month we're back to it. I mean, there is a lot
What do you
of
think caused that? What do you think causes that?
I think it's psychological. This is at the end of the day, it's psychological. I
Mhm.
mean, investors get a little spooked, harder for sponsors to raise any capital, harder for them to get any deals done, right? So I think the institutions have, they're going to be doing deals, it's the private space that I think is just a little bit more illiquid.
Right. Um, Going back to some of
By
the
the way,
mar
David, this brings up the whole Class B, Class C um, issue, which we were talking about. I think the opportunities really lie in your Class B and C workforce housing that are over, say, 20 million. And I'm
Mhm.
saying that just kind of a random number, but the point I'm trying to get across is your typical private capital multifamily syndication group that was able to raise that capital in 2022 and 2023. They either lost those contacts because they've already lost a lot of equity and they're not getting those investors back anytime soon, or it's just harder to raise money. I mean, and so I think if you are a group that's very well capitalized, I think you can go in and you can find those deals at very attractive bases with very good going in yield. It just has to do with having enough conviction from your capital partners to do so.
Yeah, I love the idea in any market of playing in that sub-institutional space,
Hmm.
and that doesn't mean go down to $5 million deals because those are still probably getting bid up and has a lot of mom and pop competition.
That's right.
But what I'm saying is that equity check that's hard for syndicators to syndicate today, and maybe they were able to syndicate that when money was flowing out of everyone's ears, but
Yep.
today you're getting extra yield and low basis strictly because there's not capital chasing that. It's due to lack of capital flow for that space. Once you start going institutional, you're playing with the big boys and they're compressing cap rates even in Dallas today for some of that newer
Sub
vintage.
five. Yeah.
Sub five, exactly. With despite concession market, despite
Right.
the flow of supply, they're still trading strictly because they're patient and wanting to buy below replacement costs. And that thesis you laid out perfectly. But with all the capital chasing that flight to quality, there is a clear disconnect in capital chasing the mid market or
Yep.
sub institutional class B and C space. So I do agree with you from a overarching theme that that's a great space to play in right now where you could get some good yield.
Yeah. Totally. You have to buy it right. You have to buy it at the right basis. I think buyers are a little bit more disciplined today than they were. So they're not going in. I mean, it's very hard to find buyers who are buying into what was once just the pitch with every single deal. Hey, come in, put in vinyl floors, push your rents by $200, something like that. Or it's now these sort of like value add pitches aren't quite as compelling. It's more so going in and maybe trimming your loss to lease and stabilizing the deal a little bit more and really focusing on operations.
Yeah, and I think to that point, most of these people trying to buy those Class BC deals, they're probably looking for day one yield of some
Yep,
sort, like cash
that's
flow
right.
today. And
That's right.
then the older deals, they probably have some deferred, and so your cap rate going in might be much different than your day one yield going in because you have to
Yeah.
still do the plumbing work, the roof work, everything like that. Are you
Yeah.
seeing pricing in Dallas for Class BC product getting to a point where net of deferred, net of loss to net of gain to lease, net of all these, mark to market that's moving NOI down, it's still a good deal from a cash flow basis? Are we at that point yet?
Yeah, it's interesting. I mean, it's like define good deal. Um, yeah, I think we're at a point where these deals pencil in terms of having positive cash flow. Um, are you getting 8 or 9 cash on cash year one? Usually not. Um, it is still pretty competitive market, and you definitely still see buyers bidding up the pricing, but you certainly have a spread of positive leverage that you certainly never had for
Hmm.
years before now.
That's a good point.
Yeah.
And maybe 8 or 9 cash on cash isn't what you need to get exact. That would be
I
like a
mean, it's
home run.
interesting.
But
I see some groups that are, targeting 6% cash on cash, very IRR driven, right, on their exit or some sort of capital event or refi. Um, I, you look, I tend to think it's a little riskier. I think, everyone wants cash flow. Cash is king now more than ever, and
right.
um, I would rather, if it were me, I'd rather have a big chunk of that IRR come from cash flow, just to be safe. But it all just depends on what's your exit pricing, and I think the cool thing about some of the Class B and C deals out there right now is you can underwrite this at an exit price 5, 7 years from now that might still be under what it sold for in 2022.
Right.
So you think about that, right? A property sells for 20 million in 2022. You buy it for, you know, 17 million in 2026, and in 2031 it's at barely 20 million again. This is
Right.
like these are some of the real scenarios where this is kind of what we're seeing. I mean, it's
Yeah.
that to me is a very compelling argument. Doesn't mean it always doesn't always pencil still, which is kind of the wild thing is, you know, there's always more to it. But
I guess
yeah,
in Dallas had such a run up. Yeah, and you saw it in some of these boom and bust pockets of other
yeah.
submarkets and markets. We're talking super theoretical at this point, but do you think it's going to take 3 years or 5 years or 7 years to kind of get back to those peak price per units? Because as you said, you're exiting to get to that return, you're exiting still below that peak pricing. So like just finger in the air, how long do you think it would take to get back to that? Not from a
Uh,
cap rate perspective, just like price per pound.
Yeah, I really don't know. I mean, so much of that's going to hinge on the absorption that we kind of started off talking about. I mean, how fast do these units fill up that have come online? Now, there's been a huge cliff of new construction, so not much hitting the market, and there are still, waves of people moving to, you know, these metros. So I don't know. If you look at it's obviously very pocket specific, so we always make these generalizations. But
Yeah.
I mean, I think give us maybe 3 years before we're kind of back into a movement and groove in place, where you're starting to see some strong rent growth again. That's my take, just based on what I'm kind of seeing in the market right now, because I still see very flat trade outs. Um, Again, very pocket specific. And if you go to a place like San Antonio, they got hit big time. I mean, big time. I still see negative trade outs every deal I've seen down there. But yeah, and that's another market. We talk about DFW, a very great, resilient market. has the new Y'all Street, has all these great factors that makes it kind of a sexy market to invest in. Then you see San Antonio, which was almost sort of treated like a Dallas in 2022,
Right.
and it's not. It's
Because
a very
everyone was
workforce
anticipating the
market.
rent growth.
Yeah, yeah. It's always overflow. I mean, Dallas got really hot, Austin got really hot, overflowed to Houston, overflowed to San Antonio, overflowed to Tyler, overflowed to El Paso, overflowed across, across the state and then into other tertiary markets. I think San Antonio got just in particular just very hit. I mean, so many new deals have been built in San Antonio that probably never should have been built in San Antonio.
What do you think is experiencing the most pain right now out of the metros
Austin,
between San
Austin,
Antonio,
yeah,
Austin,
yeah.
Dallas,
I think
and
it's Austin.
Houston?
I mean,
Yeah,
it would be a toss up between Austin and San Antonio. I think,
right.
the vibe I'm getting on the street is that San Antonio is bottomed out. The vibe I'm getting on the street is that Austin, we have no clue when it's bottoming out. So
Wow.
there's great opportunities. Again, it's, kind of taking that contrarian approach, buy low, sell high. You can buy low now. I mean, you can find deals
Yeah.
where um, they're very attractive bases in Austin and around Austin, but you still have rent growth that is very negligible, if anything. And you kind of, again, it comes back to if someone was to come to me and say, "Hey, Jack, I have X amount of money. I'm very patient. Just preserve it and in the long term, create some durable cash flow for me." There's some great opportunities in markets like San Antonio and Austin. But yeah, it's hard to find.
Hard to find. Yeah, I was pulling some CoStar, like, cumulative rent growth in the next 3 years, and Austin and San Antonio still slightly negative, while Dallas and Houston, slightly positive, and I think
Yeah,
what
that's
that
great.
translates to is exactly that. Maybe Austin, San Antonio still have a little bit of ways to go, whereas Dallas and Houston, Dallas is a massive MSA, Dallas Fort Worth,
Yeah.
and so despite the, call it, I don't know, you probably know the numbers better, but like 30,000 units coming online,
Hmm.
or
Yeah.
15,000 to 30,000 coming online a year. That's only a small percentage of the total inventory. Whereas
Yeah.
some of these Austins and even San Antonio, it's so small that when you got builders building, it really hits a dent into that MSA's
Yeah.
supply pipeline.
Yep. And Austin population growth slowed a ton, and a lot of people have left as well. So it's still a great
Why do you think that
market.
is?
I think it's post COVID, sort of the tides coming back in a
Hmm.
little bit. I think you had just this overflow of your California type, tech bros moving to Austin. And I think it's very, what I've read, and I'm no expert here, but what I've read is it's very hard to copy the talent pool that you have in Silicon Valley or in New York. And you can
Hmm.
do whatever you want to do, but DFW is still not going to compete with that. Austin's still not going to compete with that, and so forth. So I think that's kind of part of it, and companies kind of pulling back. And I also think that I think it was a fun thing for a lot of people to do. They did it. They moved to Austin. It was fun. Unfortunately, a lot of them that are now trying to sell their homes are selling them at a loss. Uh, you
Hmm.
know, it's pretty crazy to see. But I'm making some generalizations here. I'm sure there's a lot of more smarter people out there who could give you some better reason for
Yeah.
me.
Yeah, there hasn't been like a cheesy term for like the bounce back, the COVID bounce back of people moving back, but I think it's real,
Yeah,
and we haven't heard the cheesy term yet, unless I haven't heard of it yet. But there's got to be like a term of just people coming back
totally.
to where they're coming from
Yeah,
because of life, because of just the timing,
right.
maybe financially they need to come back home for whatever reason. So you're feeling that for sure. Anecdotally, even I'm moving back home, and I'm seeing
Yeah,
it
you're
in other
doing it.
markets. Yeah, I'm one of those. I'm one of those. I don't know what the term is for me right now, but I'm one of those data points.
Yeah,
Um,
totally, totally. Of course, you might have I forget who it is who's running for mayor, but might maybe LA has a goes a whole nother way here soon.
I know you could go either really, really socialist or kind of more of the same. So we'll see. We'll see. Um, Jack, I wanted to talk to you a little bit more about CRE Daily and you being part of that and the No Cap Pod and talking to all these professionals, interviewing them, getting their insights. Has that changed or shifted the way you've looked at deals and real estate and maybe share a few things that you've kind of learned through
Sure.
that process?
Yeah, that's a great question. Um, I've had an opportunity. Well, I'll take a step back. I mean, CRE Daily has over 75,000 subscribers. I co-host their podcast. Podcast took off 18 months ago. I think we're now one of the, I won't throw out numbers, but we're one of
You're
the
up
big
there.
ones.
Yeah.
And and we have had on some tremendous guests. I mean, just to give some examples, we've had on the president of NMHC. We've had on the chairman and CEO of Boston Properties. We've had on the CEO of Trimont. We've had on the president of Harbor Group. We've had on, I mean, the list really goes on and on and on of kind of very high level C-suite folks, head of real estate for Brookfield. And it's been awesome. It's been awesome because, my day to day is multifamily sales in Texas. And not only that, mostly class B and C multifamily sales. I think when you start to talk to these people and be in the room with these people who come from different backgrounds, different areas within real estate at their level, you start to learn about things and pick up on little things that you wouldn't otherwise.
Right.
And I think it has helped me put the big picture together a little bit more. In other words, when I'm looking at multifamily and I'm comparing the yield that you can get on multi in Texas right now compared to what I see some, grocery anchored retail strip centers are getting. I mean, we just had on the head of Kimco, which is the largest grocery anchored retail REIT in the country. Um, these are just things I didn't think about. Self storage. We had on the owner of the largest privately owned self storage company in the world. That if you're in New York ever, they also own Manhattan Mini Storage. It's called Storage Mart. Is the umbrella company. Um, backed by Stan Kroenke. Very interesting. You
Hmm.
start to pick up all these little tidbits. So I think it has been cool for me because it has added another layer of knowledge to have a better base when it comes to understanding my own industry. And it makes it much more fun, if that makes sense. I mean, and it really does.
It does. It's a new lens where if you were just in sales in Texas for Class B and
Mhm.
C, you look at where values were and where values are now, and you're saying, why isn't anyone buying? But
Right.
there's more to
Well,
it.
they're not buying because they can get this in
Exactly.
retail right now. It's all connected a little bit, and in one way or the other. So yeah,
Gives you
it's
more
fun.
perspective.
I think it's good to get outside of your bubble, and it definitely gives you more perspective on the market as a whole.
These deals, end of the day, are investment vehicles or investment widgets that buyers are buying as a way to make money or preserve capital or something that's beyond multifamily itself.
Hmm.
There's succession plans, there's the tax advantages, and so they're looking at multifamily Class B and C in Texas the same way they're looking at any other investment opportunity.
Totally.
And I think the fact that you're going on and talking to these great individuals who are successful in other parts of real estate and looking and creating their own widgets in other markets and other strategies. It gives you perspective of, all right, is Class BC multi in Texas?
Right.
Should it be priced here? And if not, where should it be priced relative to what else is out there?
Absolutely. Yeah. Very well said.
So, Jack, it was great having you on. Thanks again for hopping on. I
I
appreciate
I
your
I had
insight.
fun. I would do
Yeah,
this anytime with you. And
yeah.
congratulations on what you're building here. I see it all over the place. I've heard great things. So keep it up.
Thanks. Yeah, we like to just kind of talk shop. Maybe we're not the smartest people in the room, but we're in the weeds and we're
Yeah.
seeing day to
Well,
days. And
we're definitely not the smartest people in the room,
yeah,
but
exactly.
you are not
No,
not
no,
not. Yeah,
definitely,
no,
definitely
it
not.
it's been fun, and as always, you and I will stay in touch. But yeah, thanks for having me on.
Awesome. Thanks, Jack.
All right.